Welcome to All About Money on HKIBC. I'm Chloe Feng. As expected, the United States raised the cost of borrowing money by another 75 basis points, the third increase of this size in the past 4 months to tame runaway inflation. The Hong Kong Monetary Authority followed suit because of the currency peg and lifted its base rate to 3.5%, the highest level in 14 years. Among commercial banks, HSBC took the lead and pushed its prime rate up by 12.5 basis points to 5.125%. So what does it all mean for Hong Kong's property market? Joining us today is Hannah Jeong, Head of Valuation and Advisory Services of Colliers, to discuss the impact of the interest rate hikes. So Hannah, nice to have you today.
Thank you. Thank you, Chloe.
Let me start by asking your thoughts on the impact from the new interest rate hike. How would it affect Hong Kong's property market separately from the residential sector and also the commercial sector?
Yeah, I think once the U.S. Fed rate increase, that will immediately impact the HIBOR movement first in Hong Kong. Currently, the HIBOR plus mortgage loans ceiling increased to 2.75% for new residential loans, resulting the HIBOR loans are already exceeding that ceiling because the latest HIBOR was over 2.6%. So once HIBOR upward movement pressure by U.S. rate, there will be risk that bank will consider increasing the ceiling again, which will impact all the new mortgages and lower down their purchasing power. Despite the homeowners are looking to move their plan from H plus or HIBOR plus to prime minus or prime rate minus, but the recent homeowners, they cannot really do so because their valuation has been dropped and penalty lockup period normally 2 to 3 years, and they fall in that period. So it's not really able to changing their plan from HIBOR plus to P minus. And banks are nowadays not really willing to loan money given the market uncertainties. So this will slow down both first-hand, second-hand markets significantly. I believe the second-hand market will be impacted more because the first-hand buyers or developers are willing to give some incentive to get rid of their stocks. Just give you one example, our company, residential mortgage valuation inquiry. So whenever there's someone buy the flat, it will come to us to getting a valuation report. And that inquiry has reduced by 30% compared to last month due to the market changes and difficult financing market. So this will be continued to be monitored, and the slowdown is not avoidable at this moment.
Right. And also, I'm thinking, what is your forecast about the Hong Kong's real estate prices in the coming months? For example, before the end of the year, we know that now almost 1 in 10 Hong Kong real estate landlords are suffering from losses. So what is your forecast on this?
So the mass market, we are looking at overall fall by 10% within this year, so from January to December. But if we compare from the peak last year in 2021, that will be around 15%. So whether we have hit the bottom, no, I don't think so, because the interest rate hike will come continuously, and the bank will increase their prime rate, which will move up the HIBOR ceiling again. So that will slow down the market quite significantly. So we will see further drop within this year, and overall we are looking at around 10% drop. We understand the border will open pretty soon. We are discussing about international border opening by offering 0+7. However, the expectation on here is not that significant. So for example, if we open up the international border, we believe that will help the market slightly, especially the newcomers can support the rental market and easing up some of the pressures from the landlord. But transaction market demand will not see immediate boost and until the mainland border opens. So I think it really depends whether we will have a mainland border opening within this year, but I think chance is quite slim.
And if we still don't see a border reopening with the mainland, when do you think the prices will rebound in Hong Kong?
I think the fundamental will be quite important. We do have a population, although we have some of the talent move out from the Hong Kong, but we do have a supporting of a population, and job market is still healthy at this moment. And then the market economy recovery, I think that will be the key issue. And then once the prime rate stabilization or the interest rate stabilize come in, then we will see some of a move upward or stabilizing the price level. And we are expecting that will happen after the first quarter of next year.
Got it. And also, we've already seen that HSBC has already raised its prime lending rates, and other banks probably will also follow suit, probably this week. So how will the move by the commercial banks also affect the property market, having the further impact?
Prime rate and the hybrid rate are highly associated. So once, and also there's analysts saying the bank may increase prime rate twice. I think that's a real concern at this moment in the market. I think if the prime rate goes up, eventually the H plus mortgage plan have to increase their ceiling. And they will give a huge pressure for the home buyers, especially people looking for the investment purpose. The interest rate already exceeding property yield, which means you are not able to pay back the mortgage by your rental income. So we will see those investment property or investment demand will soften down for the remaining this year. However, the real home buyer for their own use, they will continue to look for the good opportunity. I think we quite disappointed that we didn't see the same impact during the COVID as a low discount, as a huge discount as a SARS time before. But we do see some of the distressed sales or urgent sales coming up. And then the market is quite closely monitoring and able to snatch those good deals. So given the liquidity in the market, people sitting on the cash quite a lot, we will see those home ownership, which will want to use it for their own purpose. I think there will be some activities, but generally this prime rate going up will limit the investment activities in the market.
And also, apparently, the U.S. Federal Reserve has flagged, more interest rate hikes, this year and also next year with the new trend or the new normal. Would you worry that Hong Kong's property market probably will encounter a crisis that we've seen in the past? So what is your thought on this?
Yeah, I think the crisis is too early to say. Again, the pent-up demand who want to own the house or residential units in the market is still strong. They're just looking at the right timing because the price has gone up quite significantly. We never expect that there will be similar. We will face such a strange phenomenon because during the COVID, people expected, the market get worse, so there will be price adjustment. But actually, we are catching up by 2018, when market was a peak. So it's a quite strange situation. But I think the prime rate going up or interest rate going up continuously will give more pressure to the market. Once it stabilizes the interest rate, that's the time people will accept as is and then start to trading in the market. The interesting I want to share with you, I look at September, just first 2 weeks, the number of listings in the market, the residential units that people want to sell and put onto the agency. That number of units increased 17% compared to February this year. That means people want to sell their units as soon as possible, and that requirement or demand increased quite significantly. And because they want to prepare the further drop, or they worry that market will get worse remaining this year. But I think next year, once the interest rate stabilize, I think that's where people will feel a little bit more comfortable and then able to trade their units.
And also, Hannah, do you think the property market will require some sort of assistance from the government? I mean, earlier, Financial Secretary Paul Chan said that despite the pressure, they don't think that the government needs to assist in this for this sector. So what do you make of his comment?
I think government put different stamp duties to calm down the market, and we will see this kind of market softening for going forward. And we already have seen from actually second half of this year. This stamp duty has been artificially protecting the market. I think it's a good idea to relax, but there are a few things I want to discuss because when all additional stamp duties come in, that was quite effective to minimize the speculative investment for housing market over the decades. For example, non-local home buyers, they are subject to total 30% stamp duty, 15% buyer's stamp duty, and then another 15% double stamp duty, which were implemented since 2012 and 2013 February. So if we compare before and after these stamp duty, say 2011 versus to 2013, actually market transaction amount dropped by 31%, and then volume dropped by 41% between that 2 years. So it is quite effective. But the question is why, one of the government mentioned that why this is mainland Chinese buyers. I don't think that's the right approach. Hong Kong, if Hong Kong want to maintain international financial hub status, removal of non-permanent resident stamp duty should be applicable for all tax players in Hong Kong instead of giving incentive to people who are not in Hong Kong. So that should be also applicable for anyone who live in Hong Kong. Like other peer cities, they're giving this kind of relaxation on the stamp duty if you live there more than 2 years, you live in that city more than 2 years. So I think that kind of idea can be brainstormed by government and then impose relaxation on that, because they will maintain, or they will at least limit the talent trainees going forward, because we have lost those international expats and mainland Chinese expats moving Hong Kong due to the unaffordable housing market in Hong Kong as well. And then second part I want to mention is a special stamp duty that was limiting speculative sales. So if you sell within 3 years, there will be different period, and then there will be different rates of sort of a penalty or stamp duty. But that is more urgent, I believe, because many home buyers, they stretch their budget to buy those residential units last 3 years. Due to home mortgage insurance program, they can benefit, and also government relax the LTV ratio. But now the market is getting worse, and some of them are going through the financial difficulties. So, but due to this heavy penalty, they can't really sell, even the price level drop, and they are hesitating trading their assets. So if the government consider to remove a special stamp duty first, that will ease up some of the pressure from the homeowners who can free up their cash, and then that will bring up the volume back to the market, because now market is not trading enough due to the interest rate hike.
All right, thank you so much for your suggestion, Hannah. We'll take a short break for now, and coming up next, we'll have more discussions on the city's commercial real estate market, so do stay tuned. Welcome back to All About Money on HKIBC. I'm Chloe Fong. Joining us today is Hannah Jeong, Head of Valuation and Advisory Services of Colliers. So we have more discussions over the city's commercial market amid the rising interest rate environment, as well as new economies emerging. Thank you so much for joining us, Hannah.
Thank you.
And now let's also talk about the city's commercial, especially on the office sector. We know that this sector has remained under huge pressure with the ongoing, border closure and the work from home trend. So looking ahead, what do you think about the outlook for this sector?
I think we are facing increasing vacancy rate of up to 11% at this moment, and it will increase further by end of the year, about 13%. But the rental decrease, because we had a huge cut last year, actually, if we compare to 2021 alone, we are only looking at minus 2% adjustment. It's interesting because early this year, 2022, we thought market will be rosier, and we see the light in the tunnel. So in the early this year, our forecast was 1% positive growth of rental, but we had the unexpected fifth wave. And then now, although it's not officially sixth wave, we do see increasing COVID cases. So overall, we are looking at about minus 2% rental decrease. But if we talk about some of the investors looking at the good deals right now, and this week we have seen the conclusion of Golden Finance Global Center, which was a huge discount, or it's almost like half of their purchase price. But this shouldn't dictate the market because it is due to the distressed condition of the owner, and that was under special situation. So I think this kind of a one-off transaction cannot really determine, oh, market will cut half of their price. But I think generally, the demand is a little bit softer, but we are expecting better performance next year given the border opening.
And looking ahead, for example, in the next 5 years, what are the new supplies that will come into the market from your point of view?
There are a number of big projects scheduled. I think you can see in Central, we have a Dell Henderson by Henderson and CK Center 2 done by Cheonggong. They will open next year, adding about 1 million square foot GFA. And then we have a West Kowloon project will come in. So West Kowloon Cultural District, they will add Artist Square Tower, which is about 500,000 square foot. And then we also have Excelsior redevelopment completion, another 500,000 square foot in Causeway Bay. So that will add, like, in 2025, we are looking at around 3 million square foot supply. And beyond that, like 2026, we will have a massive development coming in XLR Terminus, which is currently owned by Sononggai and Ping An, and that will be close to 2 million square foot. And Hysan China Camps, Causeway Bay, Caroline Hill Road, they will add another 700 million square foot. So 700,000 square foot. So it sounds like a lot, but actually in Hong Kong, it's quite reasonable because we have a net take-up average about 2.5 million per year. So if the current supply, the schedule is around 3 million per year, I think it's quite healthy supply. I just want to mention, we compare a lot with Singapore. Oh, Singapore, people moving there, so they are facing lack of residential right now, and then the office market is booming. But the funny thing was, in Singapore, they said this is the lowest vacancy rate in the history, and they published that was 8%. But in Hong Kong, we are only 11%. So because we always chasing, it was always short of a supply, and we were like below 3% vacancy rate previous years. So I don't think 11% is something dramatic. It's more healthy. And then when market recover, it will go down to below 10%. And I think that will be, compared to other peer cities, I think it's a very good market, because if you don't have that breathing space, it's very difficult for new companies coming to the Hong Kong, or when when companies want expansion or relocation, it will have a very little choices. So actually, it's good for the overall business and overall economy in Hong Kong.
And another very interesting sector is the industrial sector, and also, for example, the logistics. They have been thriving amid the pandemic. Do you think this outperforming all this kind of strong momentum will continue by the year end, or continue to the next year as well?
Yes, I think absolutely industrial assets are the star right now. Just giving you some context, last year, when we look at the overall investment transaction, 43% was from the industrial assets. So that's how dominating market. Industrial used to be not the major market. A lot was more from the office or shopping malls. But why industrial markets are popular? Because there are two angles. One is yield perspective, and then second part is add value opportunities on the conversion or different users. So in terms of yield, industrial used to be the highest yield spectrum in the spectrum. And given the interest rate hike, many of them, the interest rate is already higher than those yield, especially like residential or retail. But industrial, we still have a room, and the rental return, which is equivalent to yield, still higher than those interest rates. So investor feel safer and it's protected. So that's the one reason many investors are looking at the industrial market. And then second part is a value add opportunity. So if you have an industrial building or industrial site, you can think about, okay, I can rent out to traditional industrial users, or I can rent out to small office users, or I can also convert to cold storage, or I can convert to data center. I can convert to sort of a mixed use through the proper building application as well as the planning and land application. So there are more uses you can allow when you have a one single building, unlike other shopping mall or retail shops or even hotel buildings. So I think that was a major driver, and this momentum will continue. We do see investors asking assets on the industrial sector more than any other property sector.
And also, speaking of, amid this kind of a difficult environment, you earlier also suggested the landlords to look into, for example, the green leasing strategy. What is a green leasing strategy, and why do you think this will be a key success factor for all the landlords to survive during this difficult time?
Yeah, absolutely. The green leasing strategy is something quite important or emerging trend for many landlords, especially under the vacancy pressure right now we are facing. So what happened is that many MNCs or many tenants, they are asking, do you have an ESG initiative in your building? Is your building certified by green requirement? Or do you have a renewable energy? Do you have a recycling program? Do you use eco-friendly material? So many tenants are asking this kind of question, and landlords need to get ready for this. So that's where green leasing strategy come in. So tenants, they have their own checklist. They generally get it from their headquarters, and then they will ask a landlord to make sure they are meeting this kind of requirement. And then landlord, on the other hand, if they haven't prepared, then they will lose that kind of a tenant. So it's very important to set their KPI from the landlord side to accept this kind of green leasing. And then another important thing is green leasing, you will have some mutual interest. So make sure that the data can be shared and you can track your carbon emission, because many entities, they have a carbon zero flag. And even government, say Hong Kong government has a plan that they have to arrive at carbon neutrality by 2050. So in order to know how much carbon you are generating and how you reduce or how you arrive at carbon net zero, you need the data. So green leasing will sort of help this kind of data collection and transparency between landlord and tenant. Therefore, it's quite important factor when people or landlords plan for their future or even right now.
That's very interesting, especially now with a lot of more climate change factors. So this will also a kind of like hot topic for the real estate sector as well. And also, before we wrap up, Hannah, what are the other trends you have been seeing in Hong Kong's real estate market, especially on the commercial side as well? Can you share with us before we wrap up this episode?
Okay, we have a different trend. I think sharing economy is one thing. So co-living is a very popular trend. Co-working is coming back as long as the plan has been planned well. And then there is like ghost kitchen. People rent the industrial area and then they do the kitchen work and then using a Deliveroo or Foodpanda to go to meeting their customers. So this sharing economy is a one thing uptrend. And then, of course, we don't forget there is a metaverse, although now the cryptocurrency fluctuates so much that people a little bit away from their attention. But this is a small, but something new generation will look for their future real estate investment, one of the future real estate investment. Many developers can utilize the metaverse to promote their overseas residential, even within Hong Kong residential, to the users, especially the younger users who are familiar with the metaverse. I think that would be a great marketing tool for the developers.
Right, we can still observe how the two sectors will interact with each other in the future as well. So thank you so much for your time. That's Hannah Jeong, the Head of Valuation and Advisory Services at Colliers. And thank you for watching HKIBC. We'll be back next Sunday night. Until that next time, see you then.